Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. Here at ADISA, we're committed to insights and thought leadership all around alternative investments. My name is Greg Moz. I'm your host today, joined by my friend Matt Chansey. He is the CEO and founder of Tax Alpha Strategies. He's also a certified planner, and today we're going to be talking Roth conversions, Roth strategies. So let's lay the groundwork. Can you walk us through the basics of a Roth conversion?
Sure. Yeah. Roth conversion. You've got a bunch of money that you put inside of an IRA. You've accumulated it over time. It's hopefully deferred and grown. And then at some point you determine, well, I got to deduct this from my taxable income when I contributed to the IRA, but I would prefer that income in the future be tax-free when I take it out. So there's a process called a Roth conversion where you can convert that from an IRA to a Roth IRA. The downside to that is you have to pay taxes on it at the particular time that you decide to convert it. So when you're looking at if you want to do it or not, one of the big gotchas is never pay the tax for money inside the IRA. You want to pay it for money outside the IRA when you convert it to Roth. So you got to have some liquid cash on the outside to be able to pay that tax.
Okay, so that's the conversion part, but there's been a growing trend of people using real estate to kind of mitigate and manage some of that tax implications. Can you walk us through that?
Sure, absolutely. Real estate, and specifically the nuance around development real estate, right, has characteristics to it that allow it to qualify for, in the private equity world, what they call the J curve. So if I'm going to build a piece of real estate, I'm going to manufacture it from the ground up. So I'm going to start with dirt. I'm going to start with acres, right? So I'm going to acres. And then when it goes through the development process, you're going to turn acres into units. So you've got zoning and entitlement, permitting. Then you're going to put the underground infrastructure in place. Then you're going to assemble the sticks and bricks after you pay for your plans and all the other stuff. And then once you assemble your sticks and bricks, at some point you got a building and you get a certificate of occupancy. But that's not how they value real estate. So they base it on a cap rate calculation, which is cash flow. So you get that certificate of occupancy, then you're going to lease it up, stabilize it, convert it to a cap rate calculation, which is the cash flow that falls off the backside. And then you're going to refinance it because you're going to have construction debt on it at 65% loan to cost when you build it, but then you're going to convert it to 65% loan to value once you do your final. And then that's how you get the valuation of real estate. So there's all those different elements that create the value. So one of the unique aspects of development real estate in that value creation process is over here, I start with all the money to build the thing. I got this big pile of money. I got this big pile of cash. But as soon as I start paying for plans and paying for labor and ordering materials, well, all this money's gone. And when all the money's gone, I don't instantly have a building. I have a job site that has a bunch of stuff scattered all over it. The cash is gone. There's no building. I'm at this in-between point. And that in-between point is worth less than the value of the cash that I started with, and also worth less than the fully completed asset on the backside. So that part in the middle right there is called the J curve, commonly referred to as the J curve.
Okay. And so that's the point in time. Well, let's get more tactical here. Let's say somebody has $100,000. They are doing a Roth conversion with that whole $100,000. They do this investment in this development real estate at 100. It's gonna walk us through the next steps there, and then how does you end up making money on the back end on this development deal?
Sure. So let's assume we started with a $100,000 investment in a partnership. The way most investors are going in as a limited partner, really simply, you have two partners. You have a general partner, the person that does the thing with the expertise, and you have the limited partner, the person that has the money. And so they come together and say, other people's money. You have money. I know how to do a thing. Together we'll do a thing. So we take that money and we put it into the partnership. Well, I'm the limited partner. I'm not the general partner.
Right.
So I'm not in control of this. And so one of the things of once I've spent the cash in the J curve is I can get a discount for what's called lack of control. It's also I can't turn around typically and share or get my cash back from it. It's illiquid. So there's a lack of liquidity. That's another type of discount that applies. Typically you can't sell it or transfer it at that time. So there's a lack of marketability of it. So when you take the J curve and you take those additional, and that's a formal appraisal methodology that's very commonly used in the estate planning world to transfer assets out of somebody's estate so they don't pay estate taxes on them. We're just using that same appraisal methodology to the limited partnership interest when we're in the J curve and taking a snapshot in time of that.
Right.
So really common when you combine all those factors, the J curve with those different types of discounts to say, well, now my 100,000 is not worth 100,000. It's only worth 50,000 on paper. Right? It's a paper loss today that we manufactured and controlled a paper loss. So if we take a snapshot in time, that might be the ideal time to consider a Roth conversion because now I'm not paying taxes on 100,000, I'm paying taxes on 50,000. But you ask, well, what happens full cycle?
Yes.
So we don't stop the project and walk away. The developer's going to continue to build it. He wants to split his profits on the back of the deal. So by doing so, he continues to work on the process. We build it. We get a certificate of occupancy. We've now converted it from a taxable account to a tax-free account. And on the backside, it's not uncommon to get a mid-teens return over the hold period on an asset. So if we start over here with $100,000 and let's just say, as an example, we got a 15% annualized return over a 5-year hold period to do all of those things. We've now turned $1 into $1.75 5 years later, but we converted its value at 50 cents on the dollar. So we paid tax at the lowest point, and now we have $1.75 or $175,000 in a completely tax-free account. And that's where the value creation is.
And that's why I keep on hearing more and more about this trend. And I'm seeing more and more sponsors roll out, Roth conversion strategies on their platforms. What are the typical ranges of that valuation discount that you see?
So really common, the lowest or the smallest amount of discount that I've seen, 30 to 40% is the smallest range. The biggest that I've seen is close to 75, 80%. So it depends on the asset. It depends on where it is in the J curve. It depends on who does the appraisal, frankly, because there's different appraisers that look at the underlying assets in different ways. Sometimes they're done by big real estate appraisal firms that are valuing it based on the value of the real estate. And sometimes they're valuation firms that specialize in like kind of the estate planning world. So maybe they're not as real estate focused, but they're really valuing the partnership interest because a lot of families that own private businesses use that same methodology to decrease the value of their private business to be able to avoid estate taxes. So common tool, just depends on who does the work for you.
Sure, fair enough. Okay, so I want to shift gears a little bit. We talked about that hypothetical $100,000 example. Let's talk $1 million example here.
Sure.
So walk us through what you would do, or walk us through some options if we are going to do a Roth conversion, but want to make sure we're properly diversified across many different factors.
Absolutely. Well, I would say, and I tell this to clients all the time, no one's ever said diversification is a bad thing, right? So how do we diversify? By sponsor, right? By maybe asset class and by geographic region. Now we've given ourselves some diversification. What we probably can't diversify in this scenario is the strategy of the underlying real estate, which needs to be development to create the J curve.
Right.
So maybe we can do it with multifamily. Maybe we can do it with hospitality, hotels as an asset class. Self-storage is something that we could do. So there's different asset classes we could potentially use, and we could do them in different parts of the country. We've got sponsors that are in the southeastern United States. We've got sponsors that are in Texas, that are in the Midwest, that are in all different parts of the country. I happen to be from the South, and so there's a lot of progress or development going on in the South in all the different asset classes. So you might not be able to be right there in your backyard, but there's enough product and enough sponsors that are manufacturing assets. And make no mistake, it is manufacturing assets. This is what they do. It's an assembly line type process when you're building and developing something in this way. It's a programmatic build. It's not something that they're guessing that they're going to be able to turn sticks and bricks into a building. It's something they've done many times.
Right. Most of them have. So the point that you didn't touch on diversifying was time. Let's talk through you not having to do all your Roth conversion all at once. You can spread that out. What are your thoughts on that?
So from a timing perspective, there are some things that you want to be cognizant of. So I wouldn't suggest that somebody would convert, like you said, $1 million IRA all at one time. So we could, if we split that $1 million IRA over 2 years, for example, well, we would have only 500,000 of a conversion at the end of 1 year, creating taxable income, and then 500,000 in a second year, creating taxable income. Now, maybe that's, and you're not doing it at 500, because if we're getting, let's just, as an example, get a 50% discount, right? We split the $1 million IRA in half. Well, it's 500 on each side, but at a discounted value, it's 250 and 250. So maybe that's more manageable from a tax perspective of having an additional 250,000 split across 2 years. But even some clients like to spread it out farther than that and would maybe stage the whole process over a 5-year period. So they could do $200,000 a year of their $1 million IRA, now only doing $100,000 every year on the discounted 50 cents on the dollar value. So they've staged it over 5 years. That allows them to spread out the liability, but still compress it in a pretty short period of time, because it took them a lot more than 5 years to accumulate that $1 million in an IRA. So in the grand scheme of things, they're paying the taxes on it much, much faster than the time it took them to accumulate it.
Yeah, that's right. Couldn't agree with you more. As people look to convert, there's liquid securities and IRAs, but IRAs can have and hold all different types of assets these days. What assets work and don't work with this Roth conversion strategy?
Sure. Most clients have some liquid money, to your point, right? Stocks, bonds, mutual funds, ETFs, that's what the most commonly invested products. So these do need to be, in our industry, what private placements are typically what they might be called. So you need a type of private investment to be able to do it with, and something that we can get a third-party valuation on. There are manufacturers of these products that are doing this specifically to be able to raise capital for these in a way, and they're doing this turnkey for you. Now, it's not uncommon for a client to own something that might fit into that particular asset class, but the general partner, when he put together the deal, wasn't being mindful of how do I package this in such a way that it easily works for a conversion. And we see those clients all the time asking that question. I own an illiquid asset in my account, and I would like to convert it to an IRA. How do I do that discount thing? And it can be really complicated, or not even possible many times, if the sponsor that you worked with was not mindful enough to be able to build it and deliver the assets in a certain way, because the appraisers are going to need a lot of information from the general partner that they're going to have to share about their deal that you might not have as a limited partner just by holding on to going, well, here's my investment statement, here's what I have. That enough is probably not going to be what you need to qualify for the discount.
Got it. Matthew, thank you for walking us through all these different points of Roth conversions. Really appreciate it.
Sure, absolutely. Thanks for having me. Happy to help.
And thank you for watching another episode of Focus on Alternatives. For more content like this, please visit adisa.org, and we'll see you in the next episode.